Hey everybody, this is Sean Riley with Riley Real Estate and MassHomesale.com coming at you with another Q&A Saturday. So this week we're going to answer the question, what is buying a property subject to the existing loan? So last week we talked about seller financing very generically in the most basic situation of when somebody owns their house and they act as the bank and give a loan to the new buyer. But you can do seller financing even if you have an existing loan on your property. The most basic way is subject to, which means that the buyer, buys your property and they basically keep the mortgage that you already have on it, and they will make the payments, but the mortgage still stays in the original person's name. There are like everything else, there's positives and negatives to this. It is more risky for the seller than it is for a straight seller financing deal where they don't owe any other money and they just take out a loan, because the loan is still in your name. So in that instance, it's still on your credit. If the new person doesn't pay, then there would be a foreclosure on the property, and that would actually hit the the original person's credit. These are things that do need to be taken into account. Obviously, that's not going to be the buyer's intent, but obviously it never is. So there is a little more risk in that way, but it is another easy way for somebody to sell a property if there are issues. Again, if it won't qualify for a new loan, if it sometimes people will be willing to buy a place that is where the balance is really worth more than what the property is worth. That's not too common, but sometimes that could happen, which obviously in that instance it would work pretty well. Since the credit thing is an issue, there's actually an advantage for some sellers if you have bad credit, especially if you've fallen behind on your mortgage. If the new buyer makes payments on your mortgage for some amount of time, that'll actually help your credit. So there are some advantages that way. So really, so there's actually there's multiple ways to do subject to as well. One could be in the instance where the loan is bigger than what the agreed sales price is, the seller might actually have to pay the buyer to buy their property. That's obviously not a particularly desirable situation, but it is a way to get out from under a loan if that is the main goal. Then the most basic way is that, say you owe $100,000 and you agree to sell the place for $100,000, you just take it just like that, with no money really changing hands either way. And the last way would be, say, given simple numbers, say agree to pay $150 and the loan is $100, so you take it subject to the existing loan of $100,000 and then work out something for the other $50. It could be, maybe you just get $50,000 cash, maybe there's a down payment and another seller finance second, or there is just a straight seller finance for the whole $50,000. So there's a whole bunch of options there. The other major risk for subject to investing is that in pretty much every mortgage that's been written for the past 40 years has a due on sales clause, which, because basically it was very common for this stuff to happen in the past and there were some defaults and banks don't like that. So the bank has the right, but not the obligation, to call a loan if whenever it is sold and if it's not paid off. So there is a risk there. You talk to different people, you get different opinions on how risky that is. I have heard of a few people who've said that they've seen loans get called. I've heard many, many, many more people say that they've done this many, many times and have never seen a loan get called. So there is some risk there to both parties. So the buyer is at risk because they might lose the property that they just got. The seller is at risk because, as I said, the loan is still in their name, so it would go on their credit report. Now, there's a few different ways to handle that. Obviously, you'll get a notice about it, so it's not like it's going to be a surprise. So the new buyer can either just pay off the loan, they can refinance the loan, or they can also deed the property back to the seller. As long as the deed goes back into the original seller's name, there's not going to be a foreclosure. So that just essentially unwinds the transaction, which again is not desirable, but it would avoid the actual foreclosure if it comes down to that. So, so in a nutshell. Also, I should point out that it's not illegal. It's against a particular clause in the mortgage documents and contracts, but it's not illegal per se. If you actually look at the the standard HUD-1 settlement statement, there's actually a line on it that says loans being taken subject to. I think it's line 503. So it's common enough that it's actually on the standard closing documents. Even though most mortgages say you can't do it, it's still done enough that, like I said, it's just a standard line on the form. So that is what subject to is, and like I said, we'll probably do a few more questions on basic seller financing stuff, and I'll put a link to last week's seller financing video right below this, and I will see you guys next week. Alright, enjoy the rest of your weekend. Bye-bye.